Good morning, everyone. Thank you for joining us today on this webinar, What Happens to Your B-BBEE Compliance Targets if you make a financial loss. I am your host, Zana Brew. Denise, my esteemed colleague, will be fielding any questions that you may have, so please feel free to post these in the chat and I will revert to them following this webinar session. Right, let's get started. This webinar will look at the elements of the B-BBEE Scorecard, which use the net profit after tax to calculate the compliance targets, the requirements of the amended codes of good practice, read together with the recommendations from SANIS, the implications of not meeting these compliance targets. Let's have a look at enterprise development. There are three elements on the B-BBEE scorecard that use net profit after tax to determine their compliance targets, and I will touch on each of these in a little bit of detail. Enterprise development has a target of 1% of net profit after tax. There are a total of 5 points on the scorecard that can be achieved. This is a priority element, so it means that the measured entity is required to achieve 40% of the subminimum, which is a total of 2 out of the 5 points. The beneficiary is required to be at least 51% Black-owned or 51% Black woman-owned. They must either be an exempt micro-enterprise, or EME for short, with a turnover of between 0 and 10 million rand, or a qualifying small enterprise, also known as a QSE, with a turnover of between 10 and 50 million rand. Supplier development is 2% of net profit after tax. This is a total of 10 points on the scorecard. This is also a priority element, and it means that the measured entity will need to achieve 40% of the 10 points, which is a total of 4 points. Supplier development contributions are made to entities that already form part of the measured entity's current supply chain, while, on the other hand, enterprise development contributions are made to entities that do not form part of the supply chain. It is very important to make this differentiation when making your contributions. There are a couple of common contributions that measured entities can make to both enterprise development beneficiaries as well as supplier development beneficiaries. I thought I would touch on a few of these here. A grant contribution is a donation that is made directly to the beneficiary. One can also look at direct costs incurred in supporting the beneficiary. For example, purchasing a laptop or any sorts of goods for the beneficiary. Discounts given to the beneficiary entity in addition to normal business practice, professional services rendered by the measured entity to the beneficiary entity at no cost. This can be in the form of coaching or mentoring the beneficiary entity. It's normally done in terms of human resource capacity to these beneficiary entities. One can also look at overhead costs incurred by the measured entity on behalf of the beneficiary entity, and this is normally done in the terms of providing free rental space to the beneficiary entity. One can also look at loans on favorable terms, either standard loans or interest-free bearing loans. Those are just a few examples. Finally, we have a look at the third element, which is socioeconomic development, or SED for short. The target here is also 1% of net profit after tax. It is also 5 points on the scorecard. However, this is not a priority element. So, socioeconomic development contributions are either monetary or non-monetary contributions made to beneficiaries which are at least 75% Black South African, as defined by the Codes of Good Practice. This definition is citizens of South Africa by birth or descent, or persons that became citizens of South Africa by naturalization. This is on or before the 27th of April 1994, or if after the 27th of April 1994, they would have been entitled to acquire citizenship by naturalization prior to that date. These beneficiaries can be communities, natural persons, or groups of people. The measured entity would need to receive confirmation from a competent third party that the beneficiaries are Black as defined. An example of such a third party would be the beneficiary's auditor. It is again important to know that your beneficiaries are at least 75% or more Black. If, in fact, they are less than 75% Black, you can only account or prorata the amount of the contributions that you benefit to them. All right, these three elements constitute a total of 20 points on the scorecard, excluding 2 bonus points. We'll have a look now at how to calculate the net profit after tax targets when making a loss. The amended codes of good practice, read together with the recommendations from SANAS, dictate the steps required in order for the measured entity to determine its net profit after tax compliance targets for ED, SD, and SED. The net profit after tax or average target is applied unless the company does not make a profit in the last financial year or on average over the last 5 years. The net profit margin is less than a quarter of the industry norm. If your net profit after tax is less than a quarter of the industry norm, or if you have made a loss in the last financial period, you will apply the indicative profit margin. The indicative profit margin is defined as net profit after tax divided by turnover. In the last year where the company's profit margin is at least 1/4 of the industry norm. In practice, we are finding that there are a number of different ways in which the SANAS recommendations are being interpreted and applied by the various verification agencies. However, unfortunately, these interpretations could result in significantly different targets. If the measured entity has made a financial loss or has failed to achieve a profit which equals to or exceeds 1/4 of the industry norm, some verification agencies will apply a 5-year average in order to determine your net profit after tax, whilst other verification agencies will apply the indicative profit margin, that being the last time in the 5-year period that the measured entity made a profit in excess of 1/4 of the industry norm, and this will be applied to your compliance targets. Verification agencies are required to request your financial statements for the last 5 years and determine which industry norm is applicable to you. Even if you are making a profit, your profit may be less than 1/4 of the industry norm. Let's have a look at an example of the industry norm. You will see I have just input data here from the manufacturing industry. So the first step would be to determine which industry the measured entity belongs to. An industry consists of a group of enterprises engaged in the same or similar kinds of economic activity. Industry norms are released quarterly by Stats SA. The most recent one was issued on the 28th of January this year for the 3rd quarter of 2020, that being September 2020. If you would like a copy of this, please reach out to us and we can send it through. In our following examples, we will be looking at the manufacturing industry norm for calculation purposes. As at the 3rd quarter of 2020, the manufacturing industry norm was 1.82%. So you will see at the bottom of the screen there, it shows that in quarter 4 of 2019, it was 2.27, and we're now looking at the total of 1.82. A quarter of this would be 0.46%. In our examples, we've used a turnover of 250 million rand. Now, if you apply the 0.46% over this turnover, your estimated net profit after tax would be 1.1 million rand. You would need to establish if your current profit is greater or equal to this 1.1 million rand. We'll now have a look at some of the examples. Right, our first example has a look at the indicative profit margin. You will see here that I've input the current turnover details as well as the current net profit after tax, which is a loss of 750,000, as well as the details for the last 5 years. So we've got February 2021 up to February 2017. Per the previous slide, we are using the manufacturing industry norm, which is at 0.6%. The last time the measured entity's profit margin was greater than this 0.46% was in fact in 2020. Here the profit margin was 0.83%. When we apply the 0.83% to the current turnover of 250 million rand, we get an indicative profit margin, net profit after tax, of 2 million rand. Your net profit after tax compliance targets for enterprise development, supplier development, and socioeconomic development are based on this 2 million rand. So that would be 20,000 rand for ED, 41,000 rand for SD, and 20,000 rand for SED. I just want to note here that you do not look at the last time in the 5 years that the profit margin was the highest, just the last time that it was higher than a quarter of the industry norm. So let's say, for example, that in February 2020, you actually made a loss and it was also minus 0.83, for example. You would then move on to February 2019, where the profit margin was 3.21%. This would then be applied against the 250 million rand. Okay. In example 2, we've obviously used the same data. So we have our entity making 250 million rand turnover. Their net profit after tax is a loss of 750,000 rand. And we've input all the data from February 2021 to February 2017. Per the previous slide, again, we are using the manufacturing industry norm, which at a quarter is 0.46%. Then we will have a look at the last 5 years. So we take the last 5 years average. Again, you take the average profit margin and not the actual average numbers. So we don't take the 7.1 million rand, which is your average net profit after tax. We take the 2.7%, which is the profit margin. We now apply the 2.7% against the 250 million rand turnover. This will then give you 6.7 million rand net profit after tax. This is applied to your targets, which means for ED, you're looking at 67,000, SD, 135,000, and SED, 67,000. As you can see, there is a marked change in the net profit after tax from 2 million rand to 6.7 million rand. Your compliance targets are therefore substantially higher as well. We would like to emphasize that it is imperative to do your homework. A fatal error often made by the measured entity is not investigating whether or not its net profit after tax is above or below a quarter of the industry norm, or when making a loss, when in the last 5 years the profit margin exceeded a quarter of the industry norm. Ensure that you are forecasting your net profit after tax expectations for your financial year end. This is really not something that you want to be a surprise at the last minute. Please note that the above requirements and compliance targets may differ if a specific sector code regulates the measured entity. If the measured entity is verified under a specific sector code, the measured entity should refer to the specific requirements of that sector code. Where the sector code is quiet, refer to the steps above. Any contributions towards your ED, SD, and SED must be paid within your measured entity's financial period prior to your financial year end. No portion of the value of ED, SD, or SED contributions that are payable to the beneficiary after the financial year end can count towards the scorecard. So you cannot wait until your financial year end has come and gone to make your contributions to your beneficiaries. This is very, very important. As we mentioned, have a look at what you are projecting your net profit after tax or loss to be before you get to the end of your year. ED and SD, so enterprise development and supplier development, are both priority elements. This means that the measured entity is required to meet 40% of the subminimum of the compliance targets in order to avoid being discounted 1 BEE level. As such, it is strategically important for the measured entity to determine its net profit after tax compliant targets or your adjusted compliance targets prior to your financial year end. This will give the measured entity sufficient time to identify and implement suitable and meaningful initiatives for its chosen beneficiaries. The failure to do so could result in the measured entity being penalized by 1 BEE level, or in some cases, it could result in you being non-compliant. In closing, there is unfortunately a lot of uncertainty when it comes to the interpretation of the codes, as we all well know, particularly when the measured entity does not make a profit during any financial period. It makes it extremely difficult for this measured entity to determine its required targets for ED, SD, and SED, and to achieve its required BEE status in terms of its roadmap. From the above examples, one can see that the targets for ED, SD, and SED are significantly different. One may want to apply a more conservative approach, but spending 3 times the target is not viable. We therefore strongly recommend that the measured entity reaches out to their verification agency to confirm how they apply the interpretation of the codes and the recommendations from SANIS. In addition, as the BEE community, we intend to engage with the DTIC and SANIS to obtain consensus on this issue. If the measured entity is uncertain of how to apply the compliance targets, or whether the codes or a sector code applies, the measured entity can reach out to either myself or to Jackie so that we can provide the necessary assistance. Thank you very much for attending this webinar session today, and please do reach out to us if you have any questions.